Hey, it's Devon, and welcome to the second video of Life Cover Secrets. Now, if you've not watched the first video, please make sure that you view that because that is your foundation and helps you to understand your need for life cover, which is going to cut your premiums. In this video, I'm going to share with you a secret that took me years to figure out. And this video is going to instantly cut premiums on your life cover, especially if you've not applied this particular secret. Now let's head over to the iPad because I have a lot that I want to share with you for this one. And the secret is trying to understand how the insurance company goes about pricing a life cover. So I'm going to share with you how you can get more cover for a lower price. Now, what insurance companies do is they put individuals like yourself into risk pools. So there's going to be a risk pool here and a risk pool here. So we'll call this pool B and we'll call this pool A. Now, why is this important? This is how the insurance company prices the premium. So they're going to assess risk pool A to see from risk pool A, how many people are actually claiming from this. Now, they have actuaries who are going to do calculations based on what's happening inside this risk pool and based on yourself before you take a premium, before you actually take the cover, so they can identify your premium. Now, if the calculations were good and the insurance company makes a profit, chances are they're not going to adjust anything inside here because they made a profit. But if the insurance company makes a loss, meaning more people are claiming than what they should be claiming, then the insurance company can come back and review your premiums and then bump up your premiums. I'll talk more about that in a later video in the series. So let's go analyze why do we have two risk pools here. Well, risk pool A, and here's the secret. Risk pool A is where you complete medical tests. This is medical tests done. Risk pool B, no medicals done in this one. So this one has, you can see initially, it's a bit harder to get into because they're assessing what your health is. So the insurance company is assessing you on your blood tests. They're looking at things like your sugar, your cholesterol. Maybe they're checking if you're hypertensive. They're looking at what's taking place before they accept the cover, which means this is a lot more intensive to get into because the requirements are a bit high to come into that pool. But think from the insurance company's perspective. The more they know about you, the lower the risk you are to them. See? So just by them understanding what your risk profile is, it reduces their risk. Because they know that you are healthy, let's assume you're healthy, you've got no medical issues, it reduces the chances of you claiming. See? In which case, people inside this pool will now get a lower premium because of the fact that they are risk rated in advance. The medicals are done upfront. Now, what happens in a case where you have somebody who is diabetic? So let's use that as an example. You have a person who is diabetic coming into this type of risk pool here. Now, what the insurance companies do is, because they understand that it's just that individual that's diabetic, so it's just that person that's diabetic, they can inflate the premium only for this person. So it's just this person that has the inflated premium. And this is what we would call a loading. So they would get charged more than what they should for that, more than what a standard rate of cover would be. See? So again, it's very fair in this case because it's just the person who's coming in with some risk that affects the pool. They don't want to charge you more if your health is perfect. So they rather just charge that person more and coming into the pool. Or maybe they might reduce cover, or they might not offer certain cover benefits. Excellent, but it does not affect you because you've done your medicals in advance. This is a critical thing because, again, you want to make sure that you have been honest upfront to avoid a situation at a later stage when you actually want to be claiming. So in this case, risk pool A, you can see the insurance companies reduce the risk significantly. So if you can understand it because you know that person's health, now they're able to charge a lower price. So what takes place in risk pool B? In risk pool B, the insurance company is not sure what's happening here. They're not aware of the kind of individuals that come into that pool. Meaning inside this pool, you could have a wide variety of people that could have all types of medical illnesses. You could have someone who's diabetic. You could have somebody who had, let's say, a stroke inside this pool. You could have had someone who had cancer coming into the pool, all types of risks. And because they're not aware of who's coming into this pool, the insurance company then has to charge everybody a slightly higher price than what it would normally be. So this gets inflated, the premium here. And you can see it. So if you get a chance and you are in a position to do a quote with the insurance companies, you can actually do a quote with a company that doesn't do medicals, and you can do a quote with a company that does medicals in order for you to compare. So for example, you could say you want R1 million life cover with a company who does not ask for medicals, and R1 million life cover with a company that does ask for medicals, just so that you can compare the premiums to have a better understanding of the difference of the two. Where no medicals are done upfront, there's a lot more responsibility for you to ensure that you are being honest upfront, meaning you're declaring your set of circumstances to the insurance companies, because at the end, when it comes to claim stage, they would then do an investigation to make sure what you've given them in the beginning is correct. Meaning if you said in the beginning that you are not a diabetic, so you said you're not a diabetic, but in the end they find out, hey, actually at the time that you took this policy out, you were diabetic, that then adjusts, it's a breach in the contract, which could mean that the insurance company could void the policy or pay less, but you definitely don't want that situation happening to your family, do you? On the other hand, where medicals are done upfront, yes, they would still do some checks to see the nature of how you had passed away. But because there's less risk, because they had determined that risk in the beginning, you're a bit more assured of what's to come here, and more assured in terms of the payment, because the screening at the end is a bit less, unless the nature of you passing away was a bit suspicious. Like if it was a murder or something like that, then it could prolong from when this actually gets paid out. So there you go. These are two techniques now that you know with which to take out policies. Your medicals being done upfront, or no medicals being done at all. And then you're going to now do a quote in order to compare the two to see what benefits are being offered. Now, in addition to that, there's one last secret that I want to share with you, and that is in terms of volume of cover, as well as in terms of number of benefits. So I'll draw it in here. This is the amount of cover. Now, usually what happens is you'd find when you are in risk pool B, so if you are here where there's no medicals, because the insurance company is not familiar with the number of people or the people that come in, their health and their status, the insurance company then may limit the amount of cover, meaning there might be a ceiling on the maximum amount of cover that is available per person. On the other hand, when you are doing the medicals upfront, the insurance company is aware of your risk, of the risk that they are taking. They're aware of your health, see? And because of that, there generally is no restriction on the amount of cover. It's basically limited based on the income. So yes, there is an overall limit, because you can't over-insure yourself. They would want to protect that. But there's a lot more leeway when you have it in this way, because the medicals are done so they can assess this properly. So that's one aspect, and that covers in terms of the amount of cover. And then the next thing I want to share with you, last thing on this one, is the benefits. Meaning things like disability, things like income protection, things like illness, so what happens here with the insurance company is they have different types of disability disability benefits, different types of income protection plans and illness plans. I'll cover these in videos to come. But when you are taking something where no medicals are required upfront, again, they're unable to determine, to assess what risk is being carried. So certain benefits might not be allowed. I'll use an example. There are some disability benefits that are specific to your occupation, meaning you could tell them, we use the example of a doctor who's a surgeon. Now, the surgeon's running, the line of work is pretty specific. And as a result of that, the surgeon has the ability to take a very specific disability benefit to say, if she is unable to complete her particular duties as a surgeon, then she must receive a payout. That's a very specific kind of disability. The general disability, meaning if she was disabled, then in that case, she is still able to continue doing some other kind of work, not necessarily as a surgeon. She could be a lecturer, and therefore the disability benefit might not be paid or might be reduced. Now, when you want to get something a lot more affluent, something a lot more comprehensive, usually that requires you to complete the medical tests upfront. Okay? So again, if you're not doing the medicals, you also want to go and assess what are the benefits that are being offered for you in that, and what are the benefits being offered if you do complete the medicals. Now, all of what I've shared with you, you can actually do in advance, meaning before you commit yourself into an insurance premium, you can do this assessment to see which benefit is going to be better for you, which style is better for you, medicals done up front or no medicals. You can also then determine your amount of cover that's required. You can determine the benefits that are being offered. Excellent. So I want to hear from you. Have you found this video helpful? If you have, click the thumbs up sign and post a comment below to share with me which of the aspects that I've shared with you has been most appealing, and how does this change now the way that you're going to go about doing your life cover. Now, be sure to watch the next video in this series, because I'm going to be covering something that you definitely don't want to miss out on.